Good morning, everybody, and welcome. First off, do a sound check. This is going to be recorded, so welcome, everybody. Been an interesting summer, interesting option expiration. Loud and clear is good. I noticed the text in there that someone said we have all three. Yeah, I figured Fibonacci number today. 3 is a very important number. You've got John L. Person, that's this computer. You've got John Person, which is my other computer. And then you've got John Person Jr., which does not really exist, but it's a different computer that's going to be recording this presentation. So therefore, those are the 3 John Persons, just as a quick explanation. All right, what we do every week, we started to do it when the markets were more active almost every day, but you can notice that in the last few weeks, there hasn't been a whole lot of changes here. But if you go down to the Documents tab, highlight this for all, the Documents tab, pretty much what we do is a little bit different, just to explain to folks what we do. If you go down to that Documents tab and you open up the arrow, and there's a little scroll button. If I may, just bring this over into view. Here's the Documents tab. Everyone can see this. Highlight for all. That Documents tab. You see this button right there, the up arrow? You click on the up arrow. So there's all kinds of things, as you can see, that we've put in here, and almost since, I don't know what the storage capacity has been, but or why we've got it in April starting, but you can see all the way down here we have every single sheet that we've ever put out all year almost, as you can see, April, May, June, July, all the way down. And then if you want to find out, this is TTU 922, this is today. So the reason I point this out is that just in case, and if you just click on it, then a secondary window opens up and you can open that file. All right, that's how you get this file. And if you note here, it was last modified yesterday at 11:26 in the morning. So, you know, my Sunday mornings are done doing my homework for the week. So with that said, let's get rocking. And I'll tell you what we're looking at and what trade ideas and what we come through each and every week. So with that said, let me get the first thing we want to start with was today's sheet. Somehow, there it is. I always like this. We put a daily positive thought together, or at least a quote, some concept that I think is pretty good. So when in doubt of the markets, stay out. Markets, if you've ever noticed that you get into a trade, you do all your analysis and nothing happens, nothing happens. The reason I point this out, because it actually happened to me on Friday, where we took an excellent short position in the ES at a very nice spot. But what had happened is it actually, due to a couple things, due to the option expiration Friday, the lack of volume, there was anomalies that I had never seen in my day trading career on this type of environment. We actually had, on a 3-minute chart, literally no change in volume. There was no volume, no trades, and we had 4 dojis. That's 12 minutes in a row in an active trading period in the morning, 10:30-ish, where the market created these dojis, and the market opened and closed at the exact same price. And I'll share that with you in just a minute. So basically, we're short the market on a very thin. There was no trading on the dome. And I'll explain what I mean by that right now. So I don't look, many of you have been around a while, I don't look at the dome as far as what the bids and the asks are. But I mean, as you can see, this is thin, 290. We used to see what, 1900, 2000, 3000. What I look for, if you notice at 1997.5, scroll over here. This is the actual trading volume. You can see we're trading like 1 lot, 5 lots, a little 10 lot. So I look at how many contracts are actually trading at those prices. So when I see like a 1 lot going 37, 39, there's 2 contracts, 41. When I start to see that not being clipped at 20 and 150 increments, and I'm short the market and our room short, I get a little nervous when there's no trades, because a market that has a sell signal and goes down, guess what? It's probably too thin of a market condition for us to take advantage of. And of course, as we note, another aspect in day trading is if you're in a trade and you know that you can't be around to manage that trade all day long and you have to be somewhere or an appointment, you know what the market's giving you right now. Now, I'm not offering excuses. I'm reviewing Friday's trade, and I know we have visitors in here, but I'm doing this because we review our trades for our own community. So first and foremost is let's go through, and if you look and examine your trades and what went right and what went wrong, kind of like journaling, I think you get a better aspect of how to, when your best trades come. Are they the morning trades, afternoon trades? What's been going on? We seem to have a difference in the markets of volatility. It's the first 15 minutes of the day we see the best trend. A lot of times, like last week, we had an incredibly good trend starting in the European session, and then what happened? We get the chop and slop during the U.S. session. Last week was kind of weird in that sense. We also look at patterns where some of the best trends happen at the lunch hour when most retail traders are conditioned not to trade in that time period. So starting at around 11:30 Eastern up until about 12:30, that's when we start to see trends, and then the volume starts to pick up again at approximately 1 p.m. Eastern. So sometimes we go through this different phase where the markets have different volume, because my theory is that computers aren't afraid of the open and computers aren't need to eat. So with that said, a lot of algorithmic trading computer programming is influencing the market. I think there's also been a decline in interest in traders in options, and that's why we've seen bid and asks substantially widen in a lot of mostly liquid market conditions. So the market is acting pretty strange. So with that said, when you're short the market and it doesn't go down and you see 4 dojis in a row, I'm telling you something, it is an anomaly situation that's time to re-examine. I don't know what the market can do. I don't have a crystal ball, and I can't tell you where it'll be at 3 o'clock this afternoon. But I do know what momentum indicators and how we put together our trades. There are certain times that we can look at the market and say we've got a lot of tools to use, but that doesn't mean that every trade that we're going to get into is a winner. So we've got to stack the odds in our favor. And so what I was always taught, when you're in a winner and you're in doubt, get out and let the market then come back and it'll tell you what's going on. I'd much rather have a positive P&L tomorrow than sit in a trade and have it taken against me, because in illiquid or thin market conditions, all it takes literally is a 100 or a 200 or 300 lot contract in ES, and it pops the market up, and guess what? They clip your day trading stop and you're out of the game. So day trading is a momentum game, and so we try to stack the odds in our favor. As far as position trading, so I just want to clear that in the air and also go over why did it even come in this daily positive thought today. So when in doubt, stay out. Markets tend to scare and bore people out of good positions, and that kind of happened to us on Friday, but we had good reason because it was an event. It was option expiration, and we had the most, I guess, widely anticipated IPO, because there's, you know, with Alibaba that came out, and so not that that's going to affect my lifetime today or this week or this month. I'm not invested in Baba. So with that said, I think maybe that had something to do with that weird delayed reaction, but I don't think so. I think there was more to it, and I'll share that in a second. Anyway, this business requires patience. We get paid to wait. You wait for the right trade setup, and sometimes that's the boring thing. I don't like to trade all the time in day trading. I like to look for the right setup, and when the right setup comes, I like to have my orders in the market within a reasonable expectation of what the risk is. I'm always about risk. Many of you know me. I always say, and that's another thing I was taught in the beginning, if the risk is too great, don't do the trade, because you know what? If you have the greatest system in the world and it's 60, 70% accurate, if your risk is too great, you can't overcome that losing trade. both financially and psychologically. So be choosy about your markets, and that's why we diversify within longer term position, intermediate term positions, options positions, and we look for high probability setups. So with that said, day trading is one that we try to incorporate to get practice looking at the patterns. A pattern on a day trade actually is the same type of pattern or setup that you can apply to longer term trades. And we've got a bunch of those hanging up right now, by the way. So with that said, you get patience for waiting for the right setup, and when you're in the trade, you got to wait for that trade to mature. So for position and swing trading, that's how we hang on to winners. You let them ride out over time, and it takes patience to let that ride out over time. However, when the markets aren't acting according to your indicators and analysis, it's best to sit tight and wait. Eventually, the true trend will emerge, as is the case what happened on Friday, which was, I'd like to share that with you in just a few more moments. But in any event, you guys can take the time to read my market thoughts and observations, but I would find it interesting that the only index that lost money last week was the Russell. It lost 1.2% for the week. It was in the worst performing sectors on the week, not the day, the week. Transportation, the NASDAQ transportation sector fell 1% last week. The IXTC, which is the Internet Hardware Computer Technology sector, lost 0.75%, and even the KRE, the regional banks, lost 0.4%. And the XRT, that's the sector of retail ETF, it fell 0.5%. That's kind of interesting. Transportations are giving it up a little bit. Hardware is losing a little bit, and regional banks and consumer spending. So there are some weaknesses in the market. The strongest performing sectors was the healthcare XLV and IBB. So we'll talk about why were they up almost 2%, because the prior week they were down about 2.5%. So there was an imbalance. They just came back and lost less over a 2-week period of time. The best performing sector, which was interesting, was the Dow Jones Industrial Average. It was up almost 2%, 1.75%. So that's this chart over here, the diamonds. The diamonds broke out. Diamonds broke out with the advanced decline on the top 30 stocks. The majority of the stocks in the Dow all were positive on the week and had gains, and that shows that there is significant buying going on in all of the Dow Jones component stocks. What do they represent? The bluest blue chip of all, high dividend yielding stocks, so people aren't afraid of buying large cap, putting a lot of money to work in a very high price stock because they get paid a dividend yield. Next, it came on the heels of an incredibly strong on-balance volume breakout. To me, that is a really bizarre anomaly because we didn't see that same makeup in any of the other sectors. Also, it does not give me compelling reasons to be an aggressive buyer of stocks, because if we note, every other stock index broke and made newer lows on their advanced decline lines. And that, my friends, is a warning shot, another one. We look at the daily McClellan oscillator reading, and we compare that against the weekly. It is still suggesting that we're not as oversold as we were from a week and a half ago. Or last week, which we advised people in this room, if you look, that the McClellan oscillator went from an extreme overbought reading to an extreme oversold reading in a very short period of time. So I think we need to, maybe what I'm reading is, brace ourselves for more consolidation and continued sector rotation action, and I'll share that again and give more definite details on that. We need to be vigilant and watch for potential sell-offs still in this market, because now more than ever, the longer this market has gone on a 3-year basis, now we're entering almost 42 months without any meaningful correction. And I know this is like the boy who cried wolf, and everyone's been calling for a correction, but I'm looking at, as you recall, tops take longer to form than bottoms, and markets try to bore you out, scare you out, and convince you that now's the time to get long. And I'm sharing with you some situations that are developing that are indicating big changes coming. So we are watching and monitoring health and breadth of the top stock indices. That means I'm watching the health of the market is related to the volume and the breadth is related to advanced decline or market internal analysis. So remember, if for those that have not been here before, 2 weeks ago and even last week I've posted the stock market, which saw the greatest bull run from 1978 to 2000. It was the greatest bull run. But I want people to understand that we had between 10 and 30% corrections every 3 years along that line. We had one in 1981, 1984, 1987. Most people remember 1987 as that fateful October crash, Black Friday. 1990, we understand, okay, we invaded Kuwait. 1994. You notice the similarity, we're between 3 and 4 years here. 1997, and then 1998 was just a leftover situation. 97 was the Asian contagion crisis, the currency crisis. 98 was more long-term capital management. They didn't last long, but they lasted long enough to instill a lot of fear in the market, and most of these corrections were between 10 and 30%. Now, I also want to remind people that we did see a little 51% pullback from that little rally we had in the beginning of the new millennium in 2000 to the bottom of 2002. That was a 51% pullback. And then we had another little one in, sorry with the sarcasm, we had another major sell-off, which of course was the financial crisis created from the housing boom and of course a few other issues. But that was a 58% correction in that very short period of time from 07 to 2009. And then I think we all may have short-term memory problems, because I certainly do, because it's tough for me to remember what happened 3 weeks ago, let alone that, you know, many people might already have forgotten that little sell-off that was kind of nasty this past July, the third week of July, which we had a little cycle. It didn't last long, but it was a meaningful correction. So just to go back in history with you, we did have a 22% correction that was made in 2011, and that actually kind of pales in comparison to the 50 and 58% corrections that we saw. So if you don't think that we have corrections along the way, we do. And so you need to prepare for those. The longer a market moves and the more parabolic pricing goes, the deeper the correction comes. And that's what I think the scary thing is for the markets. Many people, there are, the stars are not lining up right now for a broad-based market rally. The stars aren't lining up for a global economic boom. We have major disparities as a global connected economy. I want you to think about this. 2 years ago, last year, even earlier this year, we're a global economy. What's good for the goose has got to be good for the gander. If U.S. conglomerate, U.S. corporations are selling abroad, and they're doing great because they're selling abroad. If abroad is in a recession, how do these U.S. conglomerate corporations, how do they expand and make monies and increase their profitability? So if they were making money because of the currency conversion, then what's going to happen as this dollar has gained a little bit of strength? Now, if recession takes over and strength of dollar, and they need to convert euros to U.S. dollars eventually to repatriate money back for payrolls, for quarterly adjustments, then I think we need to be on guard for all of those things, because you can't be selling abroad in a strong market environment and say we're doing great, and then when it's a weak environment say, yeah, we're still doing great. Something's got to give, and I'm going to share a chart with you in just a minute that reflects a comparative ratio analysis between our markets and foreign markets. So any event, I think this, because we do forget things, I will probably keep this, and you can all back test this yourself and go check what I was referring to all of these different time periods in history of market corrections that seem to last, or they're not long lasting, but they're deep corrections, they're scary corrections, And it's a matter of being in the wrong stock at the wrong time. Do you have the fortitude to hang in there and ride that without maybe at that point in time freaking out and selling on the lows? That's what the key is for the markets. So we were recommending in this rally last week, it's now time to possibly, for stock traders that are in positions that have had deep, big profits, and I'm talking for your portfolios, that maybe you may want to start implementing collar strategies. Another thing that we introduced this room to is, for a lack of a better term, the martingale option type strategy. Martingale is a term used for gambling, that if you have bet on black on the roulette table and you see black pop up 7 times, it never guarantees that the 8th time or the 9th time or the 10th time red will pop up. But if you gamble on that the next roll after 7 in a row, for example, is going to be red and it's black, then that you've lost. Now you double up your bet. Then 9, guess what? It turns up black again. Then 10, you double up again. Now you've got to be able to finance this bet. This could go on to, theoretically, I guess, infinity. You don't ever have to have a black roll up. And to give an edge to the casinos, what do they have? They got these little green spaces that gives them an edge to the market, because there is no bet that you can make on green. That's the houses thing. But you keep betting and increasing and doubling your bet size, and if you can finance that bet, because if you go double once, now you're twice, now you're 4 times, now you're 8 times, now you're 16 times, now you're 32 times, now you're 64 times. Now you can see you've got to have really deep pockets to do that. What we take that concept is this. Think about longer term. If we got a 30% correction or a 20% correction in the next 6 months, now we will most likely, if the stock market continues to rally, and where could it go? Another 3% higher, another 5% higher? 5% higher, let's take a look at that. Where would this market be on a 5% move higher? Let's just take a look at where we would be from the beginning of this year. Where could we be? And I'm going to just share this with you right now, and we're going to put things in terms for a longer term basis. So if we close the year out, and that's your benchmark, what was the net change from last year in the spiders? We closed the year out at 181.32. We are now currently up 10.5% on the spiders year to date. Where would the spiders be on a 5% move? Okay, close enough for government work, 210. So let's take a look at 210. Now what happens typically in the next few months? It's September. It's the middle of September. Typically we have a little sell-off. October we have typically, if the market adhered to its seasonally weak period of time, which this market has kind of adhered to its seasonally weak time because it hasn't really rallied aggressively, right? So you have a time period that goes into October, and then we have another thing that happens this year. We have a little election that occurs in November, and I'm not sure who's going to win more Senate seats. Is it going to be Dems or Republicans? But that could be a little concern for the market. So we generally see the election as a Tuesday in the month of November. But then also keep in mind there's another event that happens after January. We call it the January profit-taking sell-off. Typically speaking, just to prepare you in advance, this might be for day trading. You want to go somewhere else because this is not day trading session. This is to get you engaged into thinking what could be the possible catalyst to get the market to move up, and then if it does go up, what would be a catalyst for the market to see any kind of correction. We have a potential change in an election outlook, number one, and we have a Federal Reserve that could raise rates if the economy shows signs of stronger moves, or now that quantitative easing is off the table more so than it was at the beginning of the year, what if the slowdown in abroad and in China, which caused our markets to weaken today overnight, was a report in China. So with that said, what's going to cause this market to move lower? Well, you figure that if we're now in September and you've got 1, 2, 3, 4, 5, 6 months out, maybe 5 months in February, you could see from this point in time, where would the markets be if we got a small little 10% correction from that higher level? Well, we would be right back to where we started from in August. Where would the market be if we got a 20% correction? Well, let's go with 15% first. And then where would the market be? There's 15. Where would the market be at 20%? And I don't even have the room. And I'm not saying the market's going to go for a 30%. I'm just saying it has done so in the past. So a 30% correction, here are your levels that if we got up to this another, let's say we got up another 5% higher. If we got up between 3 to 5% higher, here's your correction levels. If you wanted to just see a 10% correction, a 20%, a 15% correction puts you right back into here. A 10% correction puts you right back here. And then an ugly 30% correction puts you all the way back down here. So what would you say would be more in the realm of reality? Maybe a 14% correction, and that would be somewhere about this level right here. So if we take a look at a weekly chart, we note that this rally that we've seen on last week came with a potential divergence on the advanced decline analysis, number one. Number two, if all the money or they feel very comfortable going into blue chip stocks rather than growth, which is the Russell has now made a consecutive series of lower highs and lower lows and lower lows in the advanced decline with a divergence. Not quite divergent, but we definitely saw a market failure with weakness in on-balance volume. That, my friends, is not a very positive sign. This is the NYSE. The NYSE is trailing behind making newer highs, but the NYSE is weighted with preferred stocks, which are interest rate sensitive stocks, and actual bond funds. But one thing that concerns me is that we had a sell-off on a much substantial lower breakdown in volume on the NYSE. So we need to really pay attention to watching the NYSE's chart patterns, a break below this swing low and a break below, remember last Tuesday's breakout, you break below that monthly pivot, you break below this level on a closing basis. My friends, you're in the midst of probably a deeper correction, and especially if it comes on the heels of breaking the advanced decline comparative ratio line, and that's what we'll be following over the next few days and weeks. So when I change this over to TradeStation real quick, and I want to look at our advanced decline weekly analysis, this you'll notice is the top sectors. It's a little easier to see. This is the spiders, the Qs, the Dow Jones Industrial Average. This is the Russell. This is the NASDAQ Composite Index, and this is the NYSE. And you know, the difference here is while the Dow daily charts show that we broke out to newer highs, the cumulative weekly shows that we have higher highs and lower highs. We have divergence in the Dow. That is scary. The Qs, 4 weeks in a row of almost the same type of pattern where you have almost the same area of closings. It hasn't really made any aggressive newer highs. And even though we closed higher on the Qs last week, what did the cumulative advanced decline line do? It lost. So it does show we better be cautious in this market moving forward. So when I take a look at what's happening going forward, I want everyone to kind of pay attention. ES, you still got to look for daily closes in the December under 1983, a last conditional change. That's what LCC stands for. That means the market closes below a specific low. In gold, if this thing's going to kick back up, we need to get it on a daily basis, a close above 1244. Silver, we had monthly support at 1853, and they punished silver. We were looking for an equal and opposite pattern on Monday, which I don't think will come. Also, in the euro, watch for reversals in the 128 level. Bonds, we had a daily PPS buy signal. That's a person pivot study. We have resistance up at 138. And if we do see that, we're forming for the next 2 weeks a potential bond in the bond market. We are almost what I feel is developing a longer-term head and shoulders pattern. If you just give me a second and bear with me, I know I'm promised about what sectors to look at, and that's why I am going through this extensively with everybody. And this is exactly why I'm going through these this analysis. We have a potential on the bond market head and shoulders pattern with an ascending neckline in the market. So if we are going to complete a shorter term on the daily charts head and shoulders pattern, then we need to see if the market for the next 2 weeks chops back and forth and fills in the left shoulder, the potential head, and now the right shoulder. You throw that out the window on daily closes way above this particular weekly range. This is, again, a weekly chart. Let me share with you the pattern on a daily basis. Now, why is this important? I've traded bonds since 1984. It's my market. It's like in the movie Braveheart, Ireland. It's my island. This is my market. I been trading the knob spread. I've introduced people to trading this knob spread. Look at this now. If you're going to anticipate a potential pattern, is this it would not be what we call a W bottom because it's not after a downtrend. So there must be something here. If this is the left shoulder and this is the head, then the right shoulder, to give you a technical lesson, you need the symmetry from the length of time it took to create the left shoulder. You need the equal time symmetrically in time to create the right shoulder. If it is to be symmetrical both in time and price, that means it needs to chop around for another week and a half. That's this week and potentially some of next week. So it should not get above this 138 level. It should stay in a range for the next 2 weeks. That would be my guess. And then if you get daily closes below this line in the sand in that period of time, now it's not absolute. It doesn't need to be in a complete 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 trading sessions. We only got 1, 2, 3, 4, 5, 6, 7. So think about how many more trading sessions you need if it's going to complete that potential right shoulder. Or you could make it 6, 7 sessions. But the moral of the story is you close below that neckline, take the measurement between the head and the neckline, and folks, that's where you're going to see the bonds down here near this longer term pivot support, which is now 129.28. There are changes in the markets. We absolutely have changes in the markets. We have gold selling off. We have silver selling off. You have bond market that has sold off from its highs. We have a lot of different changes in the marketplace, okay? So we have a lot of different sectors, which I wanted to share with you real quick. So when I take a look at all of these sectors, and again, let me go over here. This is the chart page I want. Here we go. When I go through all these sectors, I want you to focus on the trend status, all right? That means that there's been a stock that's been in an uptrend. Union Pacific, it's parabolic. Marriott was parabolic. A lot of these stocks are parabolic, and if you take a look at it, you'll note that when they're green, it means they're in a buy mode. They've been in a buy mode. If you got today current bar reversal, if many of these stocks that pop up and say bearish reversals, it means these stocks are going to generate daily sell signals today. So when you compare what has been green And it's been the technology, and it's been the large cap. You've got Apple. Yeah, great news. They've sold a bunch of phones. They took pre-orders for them. I don't even have a phone yet. So they took pre-orders. They've actually diluted their longer-term sales, if you think about it. People went into the store, they got a phone, but now they're doing a big push on pre-ordering. That's a great thing to get, great marketing ploy. But 3 months or 2 months down the road, they're not going to sell as much because they took all their pre-sales up front. So be aware of that. Microsoft, another large cap. These names, or IBM even. I mean, so when I take a look at the names and I say, gee, what's been going up? That makes, sense according to the Dow. It's the large cap technology stocks. I look at the material sector, and the material sector is starting to, has been in a bullish mode, but now I want you to focus in on this next time frame, which is a better time frame, and I want you to take a look at this monthly time frame, which is a more important time frame. You take a look at this chart with me together, and you say, holy goodness, on a monthly basis, we've got like a Christmas tree. Half of them are green and half of them are red. For the most part, we have a very mixed market. It's not like it was earlier this year where almost every sector was green. So we're seeing longer term changes in the market. I would absolutely employ you to take a look at the longer term charts to get a better view of the markets and the sectors and the stocks within those sectors. Now, this has gone on a little bit longer than I wanted to, and I want to give you specific trade ideas. These are some names that we like to take a look at, obviously. Adobe, which has had a significant decline. Look at this chart on a longer term pattern. I'm changing every single one to monthly so that you can take a look at the longer term trend of the market. And not only do I want you to take a longer term trend of the market, but I want you to take a look at the volume. Now, MGM, for one, which I think longer term, it's one of my core holdings because I'm long this stock all in here. And I think longer term, the casino stocks is probably one of the best consumer discretionary ways of looking at a market. In other words, if everyone has so much capital that they've paid their bills, bought their wife a little jewelry bracelet, and they can jump on a plane and spend the money they can because there are no deals on these airlines anymore, and jump to Vegas and blow some money at the crap tables and have a great time and spend $800 on a bottle of champagne in a nightclub. A Dom Perignon bottle costs $800 at a nightclub. So if you want to go out there and you got that kind of money to blow, you're doing really, really good. So with that said, note that the seasonal tendency is not the best time of the year to be even in this sector, but notice the sell-off. There's no big volume behind it. So I suspect that this market could be just establishing the low end of a range, and the range will probably get tested. My guess is back before it broke out, which is near 20 to 21 in MGM. All right, so we're going to be watching MGM. When I look at Yum Brand actually major engulfing pattern. It's going to have resistance if it gets back near 75, and you watch for sell signals there. Look at Adobe. Has a breakout, pulls back, has a bigger breakout, and there's no volume, bearish divergence. This does not look like they're accumulating this position. This looks like it's distribution. Excuse me. I wanted to change this to Marriott. When I say parabolic and I look for parabolic stocks, this is one that has gone almost straight up, departed from the means. I'm not looking for the market to crash per se, but we're not in the greatest seasonal tendency of this market, and the volume was very strong here. At the very least, what I'm looking for after this expiration, I'm looking for this market, because Marriott is no longer really a hotel or resort as much as it's also a REIT, real estate investment trust. I'm looking for the market to just pause. This is one that I am in right now. What we did last week in this room, we put on a credit call spread. In addition, I want to take a look at the monthly chart on Apple. Now, with Apple, the funny thing is, the market had a nice little breakout here, and this is again the post-split Apple, right? Apple typically, after seeing huge little runs, this is another one that's probably due for a little consolidation. So I'm not looking for it to crash and burn, but I am looking for consolidation here. From a seasonal perspective, and if I change this, you'll watch, Apple, it's not really the greatest time of the year to be a buyer of it, so watch for significant pullbacks in the market. Maybe back to 92, 95. 92 might be a little hard to digest, but in the next month, 94.5, certainly if the market's going to maybe behave, I would be more impressed with a $95, a pullback down in there, but certainly I'm not jumping on the bandwagon buying it up here. When we take a look at stocks that are on our daily list today, and if you'll note here, I put down bullish stocks. These are some, we had Clorox, and Clorox was already up. The reason I had stocks on Clorox, you remember I did this yesterday, I didn't know it was going to run up $3 today, but the reason Clorox, it popped up on our buy signal. McDonald's popped up on my buy signal. NRG, Starbucks, Time Warner, AT&T. Well, that makes sense. They're going to sell a lot more phones with that iPhone and Apple and get more contracts, I would imagine. But bearish, we had a huge list of bearish stocks here, and I'd like to point out to you that some of these stocks actually had major sell-offs, so you got to look for retracements. But let's go through this list together on some of these names. I'm just going to change the symbols. I'm going to put the bullish ones at top, and I'm going to put the bearish ones at the bottom. I'm not really, well, I'll take a look at AIG. I don't have enough room on the bottom for all the bearish stocks. So one of the last week's analysis, we noted that a lot of the car component stocks, we had AutoNations, Delphi Automotives, we had a lot of the car industry generate sell signals last week. So if you go over to your documents section, I think that's kind of important. You can take a look at and go look at last week's sheet and see what we had to say about it was interesting. We had a lot of those names pop up. Now, Steelcase actually has earnings this week, so if you take a look, more importantly, if you scroll back down, these are the reports that we have today. We have a report at the top of the hour, which gives me the luxury of speaking a little extra, and I'm almost done here. And then tonight, remember, China has Purchasers Managers Index out tonight. If we are a global economy and you believe that China has some influence in our markets, then boys and girls, you better watch 945 if you're trading Forex markets. Tomorrow, Housing Index, Richmond Fed Survey, State Street Confidence. We have a 2-year note auction. Wednesday, new home sales. That'll be important. And we have Bill Dudley speaks today. He's a voting member of the FOMC. We have, it's almost like a PR tour. We have a lot of our Federal Reserve speakers out this week at weird times, like Loretta Mester is speaking at 12:05. Charles Evans speaks at 1 p.m. So those will kind of stop the market. So make sure you print this out because it has all the important events that are coming out this week and as economic reports. AutoZone earnings came out before the bell. And again, I just am sharing with you what the indicators are pointing out to. And AutoZone, I'm sure you guys realize, is not doing great. We have a few earnings out. BlackBerry will come out this week. Jabil Circuits will come out. Paychecks will come out on Wednesday. I'm actually in a position there along on that one. You guys can, excuse me, that's Bed Bath & Beyond is on Tuesday, BBBY. BlackBerry's Friday, excuse me, I apologize. Let me repeat. That's important. I made a mistake. Best Buy, Bed Bath & Beyond. Listen, they're all very similar. Best Buy is BBY. Bed Bath & Beyond is Tuesday after the close. BlackBerry is before the open on Friday. Okay, there we go. I got it together. All right, so when I take a look at these names and I go through our stocks to watch that are on our bullish and bearish list, okay, so I wanted to take a look at, is Steelcase a real big stock that we want to, is it really optionable? Is there something we can stick our teeth in? I found it interesting, other big names like Red Hat, another big name which came out with earnings last week, obviously got actually crushed. We also have, I found it interesting that we had Expedia.com. Expedia generated a sell on the board. So when I take a look at stocks, the first thing I look at, even Netflix, and might have a great business model, et cetera, et cetera, et cetera. But again, these are all monthly charts. These are the longer-term monthly charts. And I look at their performance and I look at what has the volume done on these recent rallies over the last few months. And as you can see, AIG, not a lot. So to me, it is more indicative of not a new leg to the upside, but rather potentially more consolidation to the downside. In this particular name, AutoZone, this is consolidation. And it's tough to chase the market today with this lower move, and it's a $500 stock. Baxter Labs, it's tough to chase this market, but as you can see, we've made less aggressive higher highs in that stock. And to me, this, by just definition of looking at the patterns and connecting the dots, looks more as if it's a distribution type top pattern. And if it is going to be more of a range, we could probably see this stock back to 65 in time. Volume in the monthly charts has not been great, by the way. Expedia.com, it seems that we've made from distance of peak to peak to peak, it's narrowing. In other words, it didn't take as much time to get up here. Long shadows over the last 2 months, negligible volume. This one does not spell like it's getting ready for a new acceleration to the upside, but rather maybe the condition of a trading range. So our strategies there for some of these names are more bearish neutral rather than look for acceleration to the upside, potentially just look for the market to cease moving higher. So when I look at some of the top names, and every stock that I've just pointed out to you are in the S&P 500. So these are not, I'm not just nano picking anything. When I take a look at, and I'm going to change Expedia for ISRIG. So ISRIG generated to me a bearish, and if you note this market on a monthly basis, we'll change this to a daily chart, it generated a daily low close doji. It's already gap lower. Again, when you take a look at all the names that are on this list, to me, this does not look like it's generating a huge accumulation to the upside. Rather, it looks more like the market's generating a consolidation level, and we might see further breakdowns. It wouldn't be uncommon to see ISRIG, break down about 15, 20 bucks. I would absolutely watch for daily closes underneath that weekly low. But in the meantime, as I said, everything that's on a sell list that's had already declined, you got to look for the market to rally first and then watch to see the resistance levels, and then put on, if you're an option trader or a stock trader, at least you have something to sink your teeth into. And you'd note that at least going into October, or the October expiration, which now is prime for theta decay, we want to start looking for stocks that have over-accelerated, number one, that should go from not just a V-top, because most stocks don't do V-tops. A V-top means they go straight up and then they come straight down. Most charts go from the pattern that we've taught and have written about, where they go from a strong trend and then they go into a consolidation pattern. And I think some of these names are into that right now, a consolidation pattern. Okay, so I just wanted to go through our list from A to Z of our weekly outlook, stocks that should do well, seasonally strong. Typically, the euro currency is strong from mid-month to the first week of October. So is the British pound. So is the material sector. So let's look at the material sector. ITB, home builders, get that last big push going into the fall, into winter. And then gold and silver, which have not, I repeat, not at all conformed to their seasonality. Crude oil is typically weak, so is cocoa, so is hogs, so is the XBD regional, the broker dealers, the XCI, which we did see weakness in the computer hardware, and of course IBB. Last but not least, let me change pages here and share with you this last thought, and then we're done for the day, and we'll look for some areas of day trading for you guys. I just wanted to go over our weekly list A to Z, and so here is from the standpoint of what our markets are doing compared to the world. Let's take a look. As you can see, this is since the first day of trading of the year. What does this look like to you? All right, well, it's color-coded, so let me explain what it is. This is the S&P 500. Now, this is since 2013, all right, since the beginning of 2013. So let me go back and just look at from this year. Okay, so this is since, as you can see right here, I've just corrected this. And now let's take a kind of a gander here and look what our markets have done since the beginning of the year. The funny thing is you've noticed that the ILF is the Italian market. That's not the Italian market, excuse me, Latin America. I'm sorry, Latin America. Latin America actually had a nice little recovery here. Was up from year to date, but not when we look at relative strength, don't look at just this year. You got to go back at least 2 years, because 1 year might have been really bad and this year's just like a bounce off the low, and that's what this is. But if we take a look at comparing where our markets are, you'll note this is the S&Ps, which matches what we talked about before. We're up over almost 11% year to date. S&Ps is green, the spiders, okay? I want you to take a look at the next is the emerging markets. The emerging markets, everyone said this is a great time to get in, if you remember that. Well, unfortunately, we've gone from 15% year-to-date gain to now it's only up 8%. So if they're saying that buying the emerging market is great, remember what you're buying. You're buying what's in the EEM. Look at some of the top holdings there. You're looking at like Syria, Turkey, Egypt. You know, some of those names are contained. You have exposure to some of those areas. So sure, yeah, they've really gotten a lot better in their day and age. This is Germany. Germany is EWG. It's negative 3% on the year. Oktoberfest, they're going to have to sell an awful lot of beer to get their mojo moving. This is France, EWQ. This, again, is Malaysia over here. This is the Dow Jones right there. And this is Italy, excuse me, right there. So when you look at our European counterparts, and the strongest economy in Europe is Germany, it's negative on the year, on a year-to-date basis. So you're saying that all of these major indices and countries are have no effect on the U.S. I would have to tell you that might not be the case. So with that said, typically we do run in tangent with these markets, and there has been a detachment. Something happened at this point in time, because that's when we saw a complete reversal in the connectivity between the U.S. and the global connected markets. So with that said, there's a lot of different evidence out there that suggests take some protection. That concludes our session this morning. I thank everyone, and I'm sorry to go so long-winded, but I think that, you know, it's tough to say what are we looking for the rest of the quarter, what sectors should we be looking at, what markets look good, and what are we looking going into the end for this month and next month and the rest of the year. So hopefully you have a better understanding, and again, we'll expand on this as the week continues and move forward. Thank you all very much, and that concludes Monday's session.